So that's where we kind of like start looking at secondary options. And those typically are to do either what's called a home equity line of credit, which is just that. It's a line of credit attached to the equity you have in your home. You borrow against it, you pay back, you borrow against it, you pay back. And it typically is about a 10-year period where you could borrow and pay back. And then after that, you got to pay it back, whatever the balance is remaining at that time. The downside, so that it's very flexible. What I like about the home equity line of credit option, it is super, super flexible with that ability to borrow and pay back. What I don't like about it is that the rate is adjustable, meaning the Fed controls the rates. When they raise the rates, your rate on that is going to go up just like it does on the credit cards and car loans and things like that.
And is it dollar? I mean, is it point for point? So if they raise it one basis, you go up one basis?
Correct. So it's currently prime is what, 8.5%. So typically on a home equity line of credit, you're going to be at either prime or prime plus 0.25% or prime plus 0.5%. So every time the Fed moves the rates, you're either going up or down. So the point is, you don't want to be, have a big balance on there and expect your payment to be here, and then all of a sudden 2 years later, the Feds raise the rates 5% and your payment's up here. People could get in trouble with that. So always be careful on the home equity line of credit. Know that it is typically going to be adjustable.